Hello, good morning to all. Welcome to today's Daily Dose of Market Insights. I'm Kelvin Wong here again, the Senior Market Analyst of OANDA Asia Pacific. Very good morning. Today will be Tuesday, the 26th of March, 2024. So before we start our Daily Dose for today, let's take a look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, not financial advice or recommendation for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so as usual, before we jump straight into the short-term technical outlook for today, let's have a recap of what has taken shape or occurred yesterday in terms of events as well as economic data releases, and how does the market responded to this slew of events and data. So let's start with the performance of the US major benchmark indices first. So in fact, yesterday was another round of softness or lackluster intraday performance within the, we call it the broad-based major US stock indices. So what we could see over here in my screen, the Dow Jones, the S&P, as well as the Nasdaq 100 all ended in the red over here. So this is the S&P 500. So it ended in a rate negative 0.31%. And what's interesting over here, it closed at the low during the last closed at the lowest point during the last hour of the normal US session. That means i.e. between 3 a.m. to 4 a.m. Singapore time. So that actually represent a kind of a lack of confidence for market participants to actually come in and unleash this kind of what I call potential bullish bias throughout the end of the US session. So there's a lack of bullish bias at the end of the US session yesterday, which also gels down into our short-term bearish bias technical view that we've been highlighting since late last week exposed FOMC meeting. All right, very similar for the Nasdaq 100 as well. If you look at it over here, it also closes at the low of the day. Okay, the low of the day. And if you go back at this point for the Dow Jones, yeah, I think it's a bit slower on my screen over here. So if you go to the Dow Jones industrial average, so you see over here it closed at the low as well. Okay, so the one that is only slightly positive, okay, which is almost unchanged, positive 0.10%, is the Russell 2000. But overall, we do see a form of softness and short-term bearish bias still pretty much intact on the major US benchmark stock indices. So what is the primary, okay, other than technical factors, what are the primary, we call it economic or news factor that is reinforcing this ongoing short-term softness in the major US stock indices? Is yesterday there's another slew of what I call tick for tat retaliation between China and US, as we know that China and US is still fighting this ongoing high-tech war since 2018 and still prevalent. So yesterday, China actually made an announcement to block the use of Intel and AMD chips in government computers. All right, so it's like you scratch my back, I scratch your back. Okay, so this time, this kind of what I call what I call it ongoing rivalry within the high-tech space, especially within the global semiconductor industry space, is actually doesn't gel well for the risk-on environment, and especially it also induce increased volatility into the global markets, especially this year. Why? Because this year is the major we call it a risk event, which is the US presidential election. And we know that the controversial ex-US President Donald Trump, very likelihood he will be the Republican ticket, more or less for sure, unless he's being sued by the US government to prevent him from being elected as the Republican presidential candidate. So he really made his public speeches that one of his key agenda to actually drive to make America great again is to impose tariffs either directly or indirectly on China goods or services. So we do expect more of this kind of what you call heightened geopolitical tension between US and China as we head closer towards the presidential US presidential election campaign in the second half of this year. But nevertheless, we also understand that the US benchmark stock indices has been inching up higher and higher since the start of this year, only particularly driven by a very strong AI team play, which is the market leader is NVIDIA, spreading on towards the rest of the semiconductor. So this is the kind of what I call a single group that is actually leading a significant percentage of the gains in the major US benchmark stock indices. So we know that any little factor of risk on or risk off impact, especially risk off impact, it could actually lead to a much more vulnerable state on the major US stock indices. Why? Because it's only being held up significantly by this NVIDIA stock within the semiconductor space. All right. So if you look at yesterday's performance in the S&P 500 heat map, so we could see over here is that yes, even though NVIDIA is holding on the fort at 0.76% yesterday, the rest of the semiconductor component within the semiconductor sub-industry is majority in the red. All right, so that also starts to see a bit of what I call negative knee-jerk reaction in the other mega cap 7 stocks. Microsoft is down, Apple is down as well, Google and Meta. Then Amazon is slightly up 0.47%, and Tesla finally up after being oversold in the last couple of days. Yeah. So but later what we got to understand over here is that for how to actually we call it have a gauge or whether there is bearish or bias, we need to look at the technical chart. Okay, so what I'm going to share with you is this particular movement, just the intraday heat map, okay, indicating to us how does the breadth goes. Okay, so what we could see over here is that there are actually more reds than green in the heat map of the S&P 500. All right, so indicating to us that the breadth is still rather bearish. All right, so over this for the stock market, over to the FX space. So FX space, the US dollar actually inched lower yesterday, down negative 0.2%. So where does it inch down? It inched down right at the near term, the next resistance level, which is at 104.85. Okay, it's an inch down over here, but it still managed to trade above the 200-day and the 50-day moving average. Right, it started to inch down slightly. So the reason why you see this dollar strength sell setback story yesterday on the intraday basis is due to a heightened, we call it a much more pronounced verbal intervention from a key Japan Ministry of Finance official. Okay, so let me share with you. So yesterday he started to actually ramp up his verbal intervention. So CADA is something to bear in mind for FX market. Okay, as you know that there's various MOF. Okay, maybe a step back. How does Japan intervene the FX market? It's not by BOJ. BOJ set the monetary policy. So BOJ will only act on the instruction of Japan Ministry of Finance to actually intervene in the FX market as and when MOF officials deem is the right time to do so. All right, so it's not BOJ who set the decision, it's actually the Ministry of Finance of Japan to set the decision or when they want to intervene in the market. And market participants will be paying very close attention to actually one particular MOF officials, which is this guy called Kada. So Kada, he's actually the finance minister for international affairs. All right, you could look at my screen over here. So what does international affairs means? It means it's actually his portfolio. One of this portfolio is the international foreign exchange market. So his duty is to watch out for any undesirable move on the FX market, particularly the yen against the dollar, whether it has comes to a certain level that the Ministry of Finance got to step in to say that, hey, the yen has already weakened or strengthened too much. And yesterday, he actually delivered his most robust severe warnings in months against speculative moves. So he did mention that yesterday's last 2 weeks of move exposed BOJ is more driven by speculative rather than fundamental nature. And that actually give rise to that 105.95 being a major resistance, and as well as a level where he is actually watching for any undesirable speculative move for the yen to weaken further. So that actually explains us one of the fundamental reasons why the 105.95 refused to break on the upside for the dollar yen, and given yesterday his much more what we call it, increased tone of rhetoric on FX intervention by Qatar yesterday, actually also triggered that minor setback in dollar strength. All right, so with that, gold almost unchanged at around 0.2 to 0.3%. And what we see, interestingly, on oil, oil price, the West Texas crude oil managed to actually inch higher to positive 1.4% yesterday, right at the support at around the 81 level that we highlighted yesterday as well. So oil prices going to trade within a short-term uptrend dynamics. Okay, so what's important yesterday, we have a slew of Fed speak. So one of them was Bostic. So I did mention previously in my daily dose of market insight, Fed Bostic, which is the Atlanta chief for the, because Federal Reserve itself, there's actually split into various districts. New York, you have Cleveland, you have Atlanta. So Bostic is the boss of Atlanta, and he is in fact one of the less dovish voting FOMC member this year. So what he did mention over here is that he repeat the expectation of only just one rate cut for this year. All right. So what we could see over here is that will he start to actually sway the majority of the Federal Reserve official? I mean, because we know that the dot plot median projection is still calling for expectation of 3 interest rate cut for this year. All right. So the answer to actually answer to question to actually ask ourselves is, we need to look at what I call oil price. If oil price going to be higher and higher in the next coming of months, that could actually fit into inflationary expectation. We're going to be on the upside as well, and that could actually see the lagging PCE and CPI data starts to inch up into the summer months. So that could actually also be one of the potential we call it a risk off factor as well. All right, so that is pretty much sum up for the event that I'd like to share with you all, and data that was released yesterday that moved the market. So with that, right, let us now jump straight into the short-term technical outlook. Okay, so let us start with the major major benchmark indices first, pardon me. All right, okay, major benchmark indices, okay, over here. Okay, let us start with the Hang Seng Index, or the Hong Kong 33. And let me expand my screen so that you guys could see. Okay, so Hong Kong 33, or Hang Seng Index. Okay, so what we could see over here, there is actually another nice rejection of the 200-day moving average that was rejected yesterday, and it rejected yesterday again. Okay, and bear in mind, like those who missed yesterday's daily dose of market insight. So in fact, on Friday, I did mention that right now we are in the high odds of the Hong Kong 33 to resume its short to medium term impulsive down move within its major downtrend phase. Why? Because on last Friday, it's clearly taken out this minor ascending channel support that I drew from the low of 22nd of January over here. So indicating to us, like I keep stressing, that whatever rebound that we see at the start of this year is only a counter trend rebound phase within its major and long-term circular downtrend phase of the Hong Kong 33 index, which is the Hang Seng Index, as well as other benchmark Hong Kong Hang Seng indices as well. Why? Because the China economy still faces the risk of a deflationary risk spiral. And do not forget over here is that the preference of the China top policymaker is to actually do piecemeal fiscal and liquidity stimulus into the economy rather than a rampant upscale liquidity infusion to actually prop up risk assets that is related to China, and it has a positive spill over to the Hong Kong stock market as well. So that is not actually the main agenda of the China stock market, the China top policymaker, pardon me. So with that, whatever rebound that we see on the Hong Kong 33, there's a very high chance it will not translate into a major bullish basing formation. So enough said about that. So in the short term, first resistance to watch will be at the similar at 16,650 that I highlighted yesterday. I don't want to use this as a key short-term pivotal resistance level, as we know that it may start to be a whipsaw on an intraday basis. Why? Because it hasn't broken down the first support level yet at 16,135, which is also the 50-day moving average acting as a support as well. So no change. Any potential bounce that is then surpassing 16,960, we will still maintain that short-term bearish bias on the Hong Kong 33. First support level to watch 16,135. A break below it gives way to the next near-term support level at 15,730. Only an hourly close above 16,960 will negate this bearish tone. Pardon me, will negate this bearish tone to see another round of choppy upward movement to retest the 13th of March minor swing high area at 17,230. Above it exposes the key medium-term pivotal resistance at 17,570, 17,600. We also confluence with the downward sloping 200-day moving average. All right, Japan 225, no change. Continue to actually maintain our this ongoing minor corrective decline pullback scenario that has already taken shape since last Friday. So price action going to inch lower, trading lower high and lower low. And yesterday it hit the first support level at for 40,500, hit minor pullback, and it was actually rejected right now as we are speaking. All right, so I don't want to tighten it to 40,500 as my short-term pivotal resistance for today. I will use instead this key graphical area here that is tested much more times, 1 time, 2 time, 3 time, 4 time, rejected on yesterday. And if you do the Fibo retracement of this ongoing minor corrective decline or a phase on the Japan 225, it also correspond to the 61.8% golden ratio as well. All right, so this given us a key pivotal level. So as long as any potential bounce didn't surpass 40,860, tighten key short-term pivotal resistance for today on the Japan 225, we will still maintain this ongoing bearish bias for this minor corrective decline to play out. First support now to watch will be this zone at 39,990/39,840. We're also going to confluence with this 20-day moving average, I think, as a support soon as well. A break below 39,840 exposes the next near-term support level at 39,480. Only an hourly close above 40,860 will invalidate this ongoing minor corrective decline scenario on the Japan 225 to resume its impulsive up move within its short and medium-term uptrend phases. A potential retest the current all-time high area that was printed on last Friday, 41,175. Above it exposes the next near-term resistance at 41,475/41,660. All right, so the one that is a sole survival in terms of a very clear short-term uptrend dynamic is this German 30 index, German 30. So German 30 over here is going to trade within a very clear uptrend phase from 14th of February low, as we could see over here. I draw in this ascending channel dynamic on our hourly chart of the German 30. So with that, yesterday it already cleared above the first resistance level at 18,340 level mark over here. So now this level here will be turns into a first support level to watch for today. All right, so I don't want to target so tight at 18,340. I will use instead yesterday's European session low, which is close to that former minor swing high of last Friday, now turns into a pullback support at 18,250. So I'll be using 18,250 as my Titan key short-term pivotal support for today to maintain this ongoing short-term bullish bias on the German 30. First resistance to watch now will be at 18,500, followed by 18,570, which is the upper limit of this minor ascending channel that I drew from the low of 14th of February. Only an hourly close below 18,250 will invalidate or negate this short-term bullish tone bias on the German 30 index to kickstart a minor corrective pullback or decline scenario to expose the next near-term support at 18,050. A break below it sees 17,900 next, which is also confluence with the upward sloping 20-day moving average. US major indices, the Dow Jones Industrial Average, where we call it the US Wall Street 30 in our platform, plunges as expected, and now it's coming very close to the first support level at 39,270. So all I could see over here is there's actually a bullish divergence on the RSI, on the hourly RSI. So indicating to us that this push down that we see so far from last Friday or last Thursday's swing high exposed FOMC is a bit overstretched. So there will be a potential minor snapback rally potentially taking shape. So I do a Fibo retracement. So the key support level to watch will be the 50% Fibo retracement, also corresponding to this clear congestion area as well previously supported. You could see supported lead to that V-shaped recovery. So this was happening during Fed Chair Powell's speech. Then thereafter, it tested on last Friday, a few hours, 2 hours before that steep decline took shape on the intraday basis. So for sure, it do have a psychological impact, and as well as a Fibo retracement level, which is the 50% level, making it a very clear pivotal level to watch in any case of any of a potential snapback rally, given the bullish divergence that's being seen on the hourly RSI. So with that, first resistance to watch will be at 39,500. For sure, it shouldn't surpass any potential bounce. It shouldn't surpass 39,640. So I will use 39,640 as my short-term pivotal, Titan short-term pivotal resistance for today, to maintain that short-term bearish bias on the US Wall Street 30 in any case of any potential minor corrective rebound scenario. First support level to watch will be at 39,270, no change. A break below it exposes the next near-term support level at 38,990, with so confluence with the upward sloping 20-day moving average. Only an hourly close above 39,640 will invalidate this short-term bearish bias tones scenario to kickstart a round of choppy, we call it up move over here. Next resistance to watch will be at 39,830. Above it exposes 39,990, which is the Fibo extension level. This 1.618 Fibo extension level taken from the low of 6th of March, and also a cluster level taken from the low of 14th of February, okay, which is at 1.618 over here, 1.382. All right, so that's for the Dow Jones Industrial Average. So the Nasdaq 100 continue to actually trade sideways after hitting intraday low at the start of the US session. It traded sideways, but price action continued to trade lower high, as what we could see over here, and the RSI remains lackluster as well. Okay, at the lower high on the RSI, on the hourly RSI. So indicating to us there's this lack of short-term intraday upside momentum coming back into the Nasdaq 100. So no change. I'll be using 18,470 level as my short-term pivotal resistance level to maintain that short-term bearish bias on the Nasdaq 100. First support level to watch 18,110. A break below it exposes 17,940 next, which corresponding to the lower limit of this ongoing bearish ascending wedge dynamic that is in place since 22nd of February low. All right, only hourly close above 18,470 will invalidate this short-term bearish bias to see a potential squeeze up to test the next resistance level at 18,620, upper limit of this bearish ascending wedge, and so confluencing with the 0.764 Fibo extension that I drew from the low of 22nd of February. All right, so that's the Nasdaq 100. So all in all, in the major global stock indices that we cover, all of them are still evolving within their respective potential short-term technical bearish dynamic. The only one that is still having this bullish dynamic is the German 30 index. All right. So with that, FX market. So let us start with the European currency, euro dollar. So euro dollar yesterday we do expect a bounce to take shape because of last Friday oversold condition. So this bounce has more or less hit the first resistance level that we highlighted, which is at this 1.0840. We saw confluence with the 50-day and the 200-day moving average, I think, as a resistance as well. So no change. I'll be still using the 10870 as my short-term pivotal resistance level, which confluence with this 20-day moving average. So as long as this level didn't surpass to the upside, still maintaining that short-term bearish bias on the euro dollar. First support level to watch will be at 1.08T, 1.080. Then a break below it exposes the next near-term support level at 1.0760 level. All right, only hourly close above 1.0870 will negate this bearish tone to see the extension of this potential minor corrective rebound to expose the next near-term support level, near-term resistance level at 1.090, followed by 1.0940, which is the last Thursday minor swing high area. Okay, so that for the euro dollar. Sterling dollar. So the cable also continued to shape that bounce right up at the 200-day moving average that came with our expectation. Then now the hourly RSI is coming very close to the overbought region again. So this potential corrective bounce, minor corrective bounce, may start to more or less be exhausted on the downside potentially soon. So no change, still using that pullback resistance of that former minor ascending trend line for 14th of February low. corresponding to the 50-day moving average, also acting as a resistance level at 1.2690. So as long as 1.2690 short-term pivotal resistance didn't surpass the upside, still maintain that short-term bearish bias on the sterling dollar. First support level to watch 125.75. A break below it exposes 125.40. Only an hourly close above 126.90 will invalidate or negate this short-term bearish bias to see the extension of this minor corrective bounce. For the next near-term resistance to come in at 127.30, followed by a break above it exposes 128 figure slash 128.20, which correspond to last Thursday minor swing high and 14th of March minor swing high area. What we have over here will be the dollar yen. So dollar yen continue to be restricted below 151.95. So that is the major pivotal resistance level, and a level where I shared earlier at the start of my daily dose today, where the key MOF officials, the Vice Finmin Minister for International Affairs, is watching very closely this level. So with that, I do believe that market participants will be a bit fearful of taking a very strong bearish bets beyond this 150-195 level. So in the near term, for sure, this is a pivotal resistance level to watch. Still maintain that short-term bearish bias, but I do have a first support level for today, which is correspond to yesterday's and Friday minor swing low area, now acting as a near-term support at this 151 figure level. A break below 151 figure level exposes the next near-term support level at 150.30, which was last Thursday minor swing low that gives shape to this minor V-shaped recovery or V-shaped rebound. Only an hourly close above 151.95 potentially could expose the bullish tone to see a test on the next intermediate resistance at 152.80 next on the dollar yen. All right, so Aussie dollar. So Aussie dollar yesterday we were neutral yesterday. Why? Because of that bullish divergence on hourly RSI. So we could see over here is that the bullish divergence has more or less been worked up already. More or less has been played its part. Why? Because the hourly RSI now is coming very close to the overbought region, and now price action seems to be stalling at the bunch of key moving average, which is the 50, 200, and the 20-day moving average. So with that, I don't want to use it so tight at 65-60 level. So 65-60 level is a very key graphical resistance level. Why key? Because this level was tested on last Friday before that last steep sell-off took shape on an intraday basis. We'll look at the hourly chart very clearly, 65-60. So I'll use slightly higher than 65-60, 65-90 level, which is the golden ratio of this entire push down from the high of last Thursday, 61.8 50% is 65.90, 65.60, 65.90, 61.8%, slightly above. Okay, so any potential bounce that still be kept by 65.90, we will be flipping to a bearish bias for today on the Aussie dollar. First support level to watch for here will be 65.10. A break below 65.10 exposes the 5th March minor swing low area at 64.80. Only an hourly close above 65.90 will see another round of choppy corrective rebound scenario to retest this 21st of March minor swing high area at 66.30 / 66.50 level. Okay, this bunch of zone over here, resistance zone, which is also the minor swing high area of 8th of March. Okay, so it's a 65-6630 followed by 66.50 level. Okay, so that is for the FX market. Spot gold. So for spot gold over here, we continue to see this minor corrective pullback continue to play out. Price action yesterday can't break above 2180, so that's our first resistance level to watch. So still no change, still using 2192 as my short-term pivotal resistance level to maintain this ongoing minor corrective decline or scenario for spot gold XAU/USD to play out. First support level to watch will be at 2160 followed by 2146, which is so confluence with the minor swing low area of 18th of March and upward sloping 20-day moving average. Okay, now coming to air support at 2146 as well. Only an hourly close above 2192 will invalidate this minor corrective decline scenario to kickstart another round of impulsive up move to expose the next intermediate resistance at 2230 level. A break above it sees 2260 next. Okay, so that's for spot gold, XAU/USD. So lastly will be West Texas oil. Let me load my chart of West Texas oil. Okay, so West Texas oil continue to be supported by our short-term pivotal support level that we actually mentioned on last Friday, which is at this low here, 80-60 level. Okay, so hit the first resistance level at 82 82.30. Okay, 82.30 level. Okay, so for now, the first support level to watch will be this level over here. Okay, at 81.62. So I don't want to target so tight at 81.62. So still using 80.60 as my short-term pivotal support level. Why? Because it also corresponds to the upward sloping 20-day moving average. So as long as any potential pullback managed didn't break below 80.60, still maintain that short-term bullish bias on West Texas oil as we continue to evolve within this minor ascending channel that I drew from the low of 5th of February, this green channel over here. So first resistance to watch for today, 83.20. Above it exposes 84.90, which is close to the upper limit of the minor ascending channel. Only an hourly close below 80.60 will negate this short-term bullish bias to see another round of minor corrective decline towards the next support level at 78.80, which is correspond to the 200-day moving average. A break below it exposes 77.35, which also correspond to the upward sloping 50-day moving average. All right, so that's pretty much sum up for today's short-term technical outlook on the broad-based asset classes. So before we go, let's take a look at the economic calendar. What are the key data to look out for today's session? All right, so for today's session over here, today will be Tuesday. So what we could see over here is what we have is we do have some consumer confidence data out during the, okay, not consumer confidence data, yeah, correct, consumer confidence data out in Eurozone, which is a key Eurozone economy, which is the Germany. So Germany consumer confidence data for April out at 3 p.m. Singapore time. And thereafter, we do have some housing price data, called the S&P Casualty housing price data for the month. This is a bit late for the month of January. So that is out at 9 p.m. Singapore time. And what's important will be the latest conference board consumer confidence data for the month of March that in US that's out at 10 p.m. Singapore time. And with that, that should pretty much sum up on the economic calendar for today. And with that, do have a great day ahead, and we shall speak again tomorrow. Thank you.